Welcome back to Gold Rush Reporter. I'm your analyst, and today we're diving into a situation that most people still don't understand, or refuse to. If you think the gold and silver markets you see on paper represent real metal, you're already behind. And if you still trust futures contracts, ETFs, and synthetic positions as safe exposure, then you're walking into a burning building without realizing the floor is collapsing under you. So before we continue, make sure you're subscribed and active here, because what I'm about to explain is exactly what the mainstream financial media won't touch. Now, let's start with the simple truth that everyone seems to ignore. For decades, the paper markets were allowed to bully the physical markets. They flooded the system with contracts, paper promises, far beyond the amount of actual gold and silver that exists. The tail wagged the dog, and the financial world pretended that was normal. But that game has gone on for so long, and to such an extreme, that the cracks are turning into fractures. Now we're reaching the point where the system will be forced to answer the most basic question. Can these paper contracts actually deliver real metal? And the answer, no matter how much Wall Street hates hearing it, is no. They can't. Everything in the futures and options space starts with one assumption, that physical metal exists somewhere to back the promises. That's what derivative means. It's something built on top of something real. But when the base isn't there, the structure collapses. Gold is tight, yes, and that alone should be a red flag. But silver is the real pressure point because it's not just a monetary metal. Silver is industrial, technological, medical, military. If silver fails to deliver, the shock spreads into the real economy instantly. You can't manufacture modern electronics, solar panels, medical systems, or even missile guidance systems without silver. Every Tomahawk missile fired burns through roughly 500 ounces. The military can't substitute that with paper exposure. So imagine what happens the moment the market realizes the paper-silver supply is fiction. Imagine a world where physical silver becomes unavailable, not just expensive. Production lines halt, supply chains freeze, and industries break down because the essential metal simply isn't there. That's not a price problem. That's a structural collapse. And if that sounds dramatic, it's because most people have no idea how close we already are. But here's the part most viewers skip, so I want you to actually think about it. If silver or gold experiences failure to deliver, you're not just dealing with a metal shortage. You're dealing with the shutdown of the entire financial casino. Because the moment the illusion breaks, the brokers, banks, and insurance companies sitting on trillions in derivatives will face obligations they can't meet. And when they fail, they take customer capital with them. That's the great taking. That's what we've been warning about for more than a year. Before we go deeper into how this connects to credit markets, repo failures, interest rate distortions, and the next systemic shock, I want you to drop a comment below and tell me this honestly. If you woke up tomorrow and your brokerage account was frozen for temporary stability measures, do you even have a plan? Most people don't, and that's exactly why they lose everything in a crisis. Now let's rewind a bit to understand how we got here. In late 2019, the repo market spiked to 10% overnight, and the Federal Reserve had to inject over $100 billion every night just to keep the plumbing of the financial system from freezing. That was a warning shot, a clear signal that banks didn't trust each other anymore. The system depended on confidence, and that confidence had begun to crumble. Then came COVID. Overnight, the real economy slowed, credit demand evaporated, and central banks had the perfect cover to flood the markets with liquidity. Trillions of new currency appeared, but they didn't fix the underlying issues. They only delayed the reckoning. Fast forward to today. We're seeing the same patterns emerge, but this time with much higher stakes. Overnight rates are moving higher again. Credit is the bloodstream of the entire system. Every mortgage, every inventory shipment, every corporate loan depends on it. If credit seizes, the system seizes. Interest rates are still at generational lows, leaving almost no risk premium. Brokers, banks, and institutional investors know rates have nowhere to go but up in the long term, which means they are already preparing for another massive liquidity injection. Another round of global money printing is coming, and that will debase fiat currencies further. If the currency falls, it takes more dollars, euros, or yen to buy the same ounce of gold or silver. Here's why that matters. The paper markets, futures, ETFs, options, have grown so large relative to the actual physical supply that they have swallowed reality itself. You can trade billions of ounces on paper every day, but the world only produces hundreds of millions annually. That's not just leverage. That's a systemic imbalance. And right now, delivery requests are rising, open interest is shrinking, and physical inventories are dropping. LBMA stocks have fallen over 70% since 2020. Allocated metals are double counted. Refiners report months-long backlogs. These aren't glitches. They're symptoms of a market running on fumes. Silver is particularly exposed. Junk silver, the most liquid and smallest denominations, has become both the cheapest to buy and the most secure form of physical ownership in the US. Right now, bids are under spot, but the supply of junk silver being sold is drying up. Refiners are melting down coins to fulfill backlogs, which destroys supply. When the temporary glut passes, junk silver may become the most expensive form of silver in the country, higher than eagles, higher than any minted coins. This isn't theory. It's happening. The system depends on confidence more than capital. When people stop believing the paper markets reflect reality, the illusion collapses. That's the point we're at today. The system runs on faith. Every treasury bond, every derivative, every bank deposit is just an IOU. And when people demand delivery of real metal, that faith is tested, and the cracks in the system become visible. Now let's look at what happens if silver fails to deliver. Unlike gold, silver isn't just an investment metal. It's industrial infrastructure. It's in every smartphone, every solar panel, every medical sterilization unit, and every Tomahawk missile, which consumes roughly 500 ounces of silver each. If physical silver isn't available, production lines stall, energy systems falter, and technological progress slows. The industrial demand is relentless, and unlike speculators, industrial users don't negotiate with the market. They go to the front of the line and pay whatever it takes to secure supply. Here's the core problem. The paper markets have promised far more metal than exists. Every futures contract, every ETF share, every options chain is backed by a derivative of physical metal. That's fine until someone actually demands delivery. And that's exactly what's happening now. Open interest is shrinking, delivery requests are rising, and physical stocks are disappearing. COMEX warehouses and LBMA inventories are a fraction of what they were a decade ago. Allocated metals are being double counted. Refiners are reporting months-long backlogs. These aren't just anomalies. These are warnings, flashing red. This leads to the great taking. The system is built to capture your capital when it fails. You think you own your brokerage account or bank deposits? Wrong. You are an unsecured creditor. When the system freezes, those assets become collateral for the institution's liabilities. Bail-ins are written into law. Your paper wealth can be seized to cover their losses. The only way to avoid this is to hold physical assets outside the system. Gold and silver in your possession. That's survival, not speculation. Look at credit again. It's the bloodstream of this global economy. Mortgages, auto loans, corporate financing, every shipment, all rely on credit. When credit tightens, arteries clog and the system starts failing. In 2008, in 2019, and today, the pattern repeats. Credit stress leads to panic. Debt levels are astronomical. $35 trillion in the US alone. The Treasury rolls over $10 trillion a year in short-term notes just to stay solvent. Long-duration bonds collapse because the world doubts repayment. Investors chase tangible assets, commodities, land, metals, energy. That's exactly what we're seeing. Central banks will intervene, print more money, but that only erodes the value of fiat further. Gold rises, silver coils, and physical accumulation by central banks accelerates quietly. This isn't conspiracy. It's simple math. When supply is fixed and money supply expands, prices rise. The takeaway? Delivery failures, industrial demand, and systemic mistrust converge to create a perfect storm. The paper markets can no longer be trusted. The illusion is ending. The physical metal you hold becomes the only true refuge. Let's take this to the final piece. The systemic collapse scenario. The system doesn't fail in a single headline event. It collapses quietly, then suddenly. When the casino doors close, your paper wealth is trapped. This is why physical gold and silver are non-negotiable. They survive when everything else fails. The great taking isn't hypothetical. It's encoded in law and practice. Bail-ins, frozen accounts, seizure of collateral. These are not fringe ideas. Cyprus, multiple European banks, even US law under Dodd-Frank. All of it shows the system prioritizes itself over individual capital. Paper contracts, ETFS, futures, all illusions. Only physical metal endures. The timeline is critical. In the coming months, maybe weeks, delivery failures will become visible. The cracks in the paper markets will show. Open interest will shrink. Premiums on physical will spike, and industrial demand will clash with speculative positions. Junk silver, in particular, will gain value as supply is destroyed. Coins that were liquid will be melted down, reducing availability and driving prices higher than eagles or other bullion. This isn't about greed, it's about survival. When trust evaporates, money returns to its natural state. Physical, scarce, and real. Gold and silver are not optional. They are the exit door from a system built on faith in promises, not possession. When the music stops, the holders of paper will be trapped, and those with metal will already be outside, safe. Finally, it's crucial for viewers to understand the broader message. Monitor delivery months, watch premiums, track open interest, and understand that systemic trust is failing across banks, central banks, and governments. The only way to protect wealth is to own physical metal, hold it outside the banking system, and be ready for the next phase of this crisis. That's the reality of today's metals markets. The paper illusion is cracking. Delivery failures, shrinking inventories, and rising premiums are not anomalies. They're warnings. Gold and silver are signaling the stress in the system, the lack of trust, and the approaching revaluation of everything tied to fiat currency. The lesson is clear. If you want to survive financially, you need to move your capital into something tangible, something real. Gold and silver aren't just investments. They're insurance, they're preservation, and they're the exit strategy from a system built on borrowed confidence. Remember, history repeats itself. Every empire that printed beyond its means eventually saw paper wealth vanish while physical metal endured. Don't wait for the crisis to hit your doorstep. Act now. Protect your assets. Hold physical gold and silver. If you want to stay ahead of these developments, get timely updates on silver and gold prices, breaking news, and expert insights by subscribing to our free newsletter. The link is in the description. Thank you for watching Gold Rush Reporter. Stay vigilant, stay informed, and most importantly, stay prepared. We'll see you in the next update.